Let me begin by extending my gratitude to Bob and Jerry and all people at Perry for organizing this conference. It's really been great, and it's a privilege to be here. I'm going to talk briefly about some supply side, some sources of supply side inflation, and some policy mitigating actions that could be taken in the short and medium term to do something about it. And then I just want to make a couple of remarks about something I've observed in data that suggests think about the success of the Great Moderation in different ways. First, the pattern of inflation in this recovery is lots of ways remarkable. Even though the blue line is the ratio of output to capacity output, CBU, it's a full GDP, operation. It's not really higher than it was measurably in the previous period, but the pattern of prices is much different. Right? The absolute rate's higher, volatility is much greater, and probably not possible to account for this increased volatility, which is statistically different if you look at the coefficients of variations for the two periods. Yes.
You pick up the and
I'm sorry. These two peaks approximately correlate to the impulses in distribution of ARP funding in the second quarter of 2020, second quarter of 2021. That isn't the total explanation for these big jumps in annualized inflation. You still see very large volatility in the subsequent periods. So there's clearly something going on here that's really different from the preceding period. The other thing that's really remarkable, and this is something I want to come back to, the commodities inflation, the commodities part of the core inflation, is essentially zero in the preceding period. As we get into this period, it diverges a lot in a direction from services inflation. Okay, so there's a big jump. This is clearly has demand components, but argue it's not exclusively. But I do want to go back to the fact that this stability in core commodities prices, which is essentially manufacturing prices, extends far back in time to the late 80s, right? Whereas in previous periods, so when people look at of what happened, there's a desire to assign it to fiscal policy, but while fiscal policy has played an incredible role, I mean, there's been $5 trillion worth of fiscal stimulus in a relatively short period of time. There have been supply shocks elsewhere in the labor market, in global manufacturing, including the US, and because of supply shortages, I would argue, it's allowed corporations with power to increase that power, at least in the short term. So first, it's clear that something's going on in the labor market. Just look at the growth in average hourly earnings in a period with the same capital capacity utilization. We're in the 3.5% range. Then we jump to the second period after the COVID recovery, and the rate's around 5%. 5%, by the way, is not a rate that's accelerating, right? Something interesting to think about, because one of the favorite measures the labor market taught us is the ratio of to the number of job openings, right? In non-farm sector. And it was at
It's like, well,
a relatively low level from given the period for which vacancy rate is available prior to the downturn. But that corresponded to relatively stable money wage inflation. Right, we jumped to a pandemic or the post-downturn period. That rate jumps up for lots of different reasons, and then it starts to come down. It is actually quite a bit lower than it was pre-pandemic. However, that is not just a function of demand for labor. There have been changes in labor supply. Their forced participation rate recovered to its pre-pandemic. That's taken about 1 million workers out of the labor force. There have been restrictions on immigration, and those restrictions have reduced the labor force by about 2 million people. So if you take those two facts together, go back and do a kind of counterfactual arithmetic, even though you really need a fully specified macroeconometric model to get multiplier effects of employment into the population, that ratio would be approximately what it was prior to downturn. That is the unemployed to vacancy ratio. So 2 different ways. Immigration policy changes that changed net immigration, made it negative. And the failure to be able to protect workers enough that they could actually function in the labor market.
let me say that you use that.
Yeah.
Are you back if I do this? Okay. Okay, so supply shortages, supply shifts in the labor market. Secondly, lockdowns and COVID waves have really manufacturing supply. One place where supply has just really been physically halted, right, is in autos, and you can see the effect. This is production in thousands of units in blue. Then it's approximately 40% from the average level pre-crisis or pre-downturn. And the effect is predictable. If you look at the percentage change on the right-hand side, although it's still, above 7%. So some of what we're getting are these kinds of physical disruptions in supply. And we're also getting delays and interruptions from lots of things that are both intermediate and final demand goods from the global supply chain. Fed's index, which uses things like delivery or increases in containerized freight prices to identify delays and bottlenecks, can be used to show in some pretty nifty econometrics that that's added about a percentage point domestic inflation. Definitely, pricing decisions have clearly played a role. This is just a measure of the markup for the non-financial corporate sector constructional income account data. So it's profits over total costs for non-financial corporations. And the behavior of this markup variable is the markup will rise, right? Then it'll get some level and stabilize. But if you look at the jump in the markup from the trough of the previous recession and compare it to the jump in the markup in this recession, you get about a percentage point increase, and that translates into price increase. So just a relatively casual look at those areas suggests that supplies played a role. And I should just go back and make a point here. Lots of observers who are looking at the effect of market power and corporate power pricing have said, well, the fact that markups are rising doesn't really reflect corporate power, right? Because monopoly power is constant, it's going to pass through prices. But in fact, in a situation where supply is disrupted, and which effectively takes the number of suppliers down, right? If you think about this in a game theory context where players are playing Kuno, where they take the supply of others as given and then determine their own supply, and that set of game decisions leads to the overall markup. This is perfectly consistent with market power getting a boost in market power, playing their usual game, and raising their margins. So that's the kind of core story. The energy story, I think it's useful to remember that there's a really big cartel on the supply side, right? Barrels of oil across the world in a day, and OPEC typically buys about 40 of those 100 million. And although demand has a lot to do with what's going on in the oil market, it's generally the case that if you look at the ways the Saudis are deciding how to use their marketing, when they start ordering the capacity, it's usually followed by a rise in WTI prices. The correlations are perfect because global demand, plays a really big role here, but that's really true. And I think it's pretty well known that in 2019, the Saudis were not really happy with oil prices, and OPEC was not really happy with oil prices, and so they started cutting supply. And the Saudis are the important marginal player, but them. And as a consequence, we went into this downturn with one of the major suppliers already having acted to reduce supply. Right. So a lot of increases in oil prices, at least in part because there's an engineered shock. And I also think the point that Jamie Galbraith made earlier about the reduction in U.S. fracking is important. That's down. That's not a cartel decision. It's a decision of financial players who decided the rate of return on fracking ought to be, and they decided not to deploy additional capital to open more fracking wells, because fracking wells don't operate very long. That is, they have to be constructed, and then they have a lifespan of years of good production, and then another one has to be drilled. And there was a decision, I think, on the part of the financial backers of these frackers that they would not fund additional domestic supply that wasn't making a really good rate of return. So when you think of that as a supply shock, or not, it really had a contribution, a really significant contribution. So I'm not going to go into detail about this, but the paper talks about ways in which we mitigate in the short term and maybe the medium term some of the supply disruptions that we've observed. I think it's important to remember that the underlying source of many of these problems is the pandemic, and the pandemic continues. And at this moment, the US government does not fund additional supplies of vaccine, and they're really not in the position to fund the research and production of the next generation of vaccines that are made. That's something that could be changed very quickly it's a very difficult moment. Secondly, you saw the labor force participation, and a partial explanation of that is that people who have to care for children and people who have to care for other adults don't have any support. And so when something goes wrong, a kid gets sick, they get sick, lots of labor gets withdrawn from the market. And that's something could be, again, regulated very, very quickly. Support for childcare, support for home care could, in fact, have a big impact on labor force supply and labor force participation. The fact that programs can have thank you, Jamie. The fact okay. Sorry. And the fact that these programs could have an amazing immediate effect is reflected in the success of the child care tax credit. That is the biggest drop in child poverty that we've observed as a consequence of policy happened very rapidly because of an expenditure policy embedded in CARES and rescue plan. In the longer term, antitrust enforcement, I think, is important. It's going to take a lot to get it going. The new leadership at FTC and DOJ revise the merger guidelines and make it much more difficult for corporations to combine. The FTC is exploring the use of legal power, which they've actually never used, to make rules to prevent anti-competitive behavior. These kinds of innovations might, in fact, in the relatively near future, start to have an effect on the behavior of corporations with market power, just at least in the deterrent sense. They might walk away from mergers that they are considering, and they might think twice on some of the stuff they're doing in terms of pricing, knowing that the merger authorities and the antitrust authorities can be applied. And finally, you know, we're in the thrall of fossil fuel, and we don't have a transportation system apart from from the automobile. So anything we can do to eliminate the use is important. I think the Inflation Reduction Act contains lots of money that's going to be used to subsidize electric vehicles, subsidize battery production. And I think that that's actually, it's going to need to be expanded enormously, but it is going to have a relatively quick effect. And I think you can see that subsidies, as opposed to regulation and tax penalties for carbon emissions, is getting traction with industry. That is, I don't know if you saw the story a few days ago, power industry, which essentially was the reason that I think Joe Manchin provided the fifth vote for the IRA, right? He was the holdup all along. They were unable to convince him that he ought to vote for that package. But there was a very concerted push by the utility industry to look at cities that were on the table and thought, we really need this. We'd like $2 billion over 10. And they got it. So I think that there are ways in the relatively near future to reduce consumption, to be free, but they're possible. Okay, one last point. As I mentioned, I've been struck by the fact that commodities prices have been like virtually steady since the 80s. And this is the ratio of commodities price inflation to services inflation. It used to be about 0.5, right? if you go back to the early 60s through the 80s, it's inflation in commodities was about and now it drops to zero after the 80s, right? How is this possible? Is it incredibly rapid growth? Or some other factor? I looked at some of those data just casually. I'm not convinced, but it does correlate with essentially locating production to the low-wage countries in the world, right? And this is the ratio of imports from China to manufacturing imports. So if that in fact is correct, if the change in commodities price inflation really relates to supply changes, at least in part, we're going to think about moderation for the moderation being a function of a little more closely. Next.
Thank you. So next we have Kate Bahn and Michael Madowitz from the Washington Center for Equitable Growth.
Yes. I'm also very short, so this is next to this is very better for me. Yeah, podiums tend to cover face. Great. Yeah, I think we're good to go. I also want to repeat the thank you for having us here. I'm really, really excited to be a part of this. I'm Kate Bahn. I'm the Director of Policy and Chief Economist at the Washington Center for Equitable Growth. I'm joined by my colleague, who's new Director of Macroeconomic Policy. So Michael do the heavy lifting of the presentation today. And our third co-author, who's not here with us, is Carmen Sanchez-Cumming. So I'm going to give a brief overview of where we're going to go today. And I think, the underlying thing that we're thinking about is that there's been some big structural changes to the economy that we think lead us to question some of the underlying assumptions and intuitions behind some sort of traditional simplified economic frameworks. And so it's not just that. I think we've seen a lot of presentations today with really great stylized facts showing us that the myths that people uphold with these models are held true. But I think we also want to start to question about how it's fundamentally different than it used to be. What does this mean about different macroeconomic dynamics? Not just we've disproven a previous model, but what's actually happening right now? And then a big piece of this is understanding what has happened to the neutral interest rate. And so that is a lot of what Mike will be talking about. Low rates are either over or not. It's hard to say which it is. These are one of our big questions. We'll go through some of that intuition behind that as we figure that out. And then the other piece sort of that we're thinking about here that is on this is that also this has changed sort of the competitive dynamics in the economy has changed a lot of these, what we expect of what interest rates will do, interest rate increases will do, and also the shape of the Phillips curve. So just in brief, I think people here in this room know this, but there's high levels of income inequality. And we think that that's really shaped fundamental macro dynamics like savings, the global savings glut, investment, supply and demand. And thinking through the traditional frameworks that rely on things like representative agents don't make sense in this level of inequality that we're seeing. There's also no reason to believe a wage price spiral is possible. I think this room totally agrees with that. So I don't want to belabor that point too much. It's just the stylized facts that we see possible. There are certain assumptions that have to hold for a wage price spiral to be sustained. And there's no reason to think that we live in an economy where those assumptions are reasonable anymore. So for example, the fact that it requires an iterative process. It's not just, we may have seen a one-time bump in wages recently, but it has to be an iterative process that workers are able to continually ask for higher wages and demand higher wages. It can't just be a one-time adjustment. For it to be a spiral, it has to continue to happen. And particularly for workers that we're seeing with higher wages now are low wage workers who are facing wage posting versus wage bargaining. So there's even less reason to believe that would happen. Like one example I think of is there's a recent paper by your colleague Erin Dubé. We look at even for workers, Walmart workers, even if they know there's a higher wage where they can't bargain for a higher wage in their employer will say, no, I'm sorry, this all will pay you. You have to take it or leave it. So we know there's no bargaining for most of these workers. Also, more or less labor market indicators are moderating. I mean, this report with a little bit more that would be, but more or less, we are sort of getting much closer to what the monthly average job growth was prior to the pandemic. Another question that has to hold for a wage price spiral is that productivity growth has to be you can't, if you have higher productivity growth, the wage price spiral would not be true. And so it's a little bit mixed of a picture of what happened in the past few years, but we did have higher productivity in 2021 than we do this year. And so the period with higher inflation also had higher productivity, and you can see increases without it feeding into inflation in periods where there's higher productivity. So there's just some of the fundamental reasons that we think they might be different. And with that, I will hand it over to Mike on neutral interest rates.
Thank you, Kate. And thanks, y'all. Seconding or quadrupling whatever folks have said here. It's really lovely to talk to y'all and basically do like 2 months of background research on it. What's going on, like 2 days. I've been very into R-star or our neutral real interest rates for a while now. So backing up for a second, this is not the like the Fed is juicing the economy, keeping the interest rates too low. This is like the Fed is following standard rules, and the result of that is that interest rates are really low. And I guess this guy starts in like, well, technically it starts in the 60s. But sort of the point where this became a really salient fact was like, and you've kind of seen a lot of the literature deal with what are we going to do now that we have low inflation and low interest rates. It's like maybe late 90s, early 2000s. And, you know, the variety of approaches here, but they all kind of land in the same general space, which is you have, if you take like a standard Taylor formulation of we're going to set Fed rates to stabilize inflation and try and keep it about where it can neutrally be. If you're in a case where you have low neutral rates and low inflation, you have to be very worried about hitting a zero lower bound. And the sort of obvious conclusion of that is, well, then you change how you handle your policy rates, right? You need to have some sort of shadow value of hitting zero baked into this. And I think we dealt with a lot of one side of this in recovery, and it sucked, which was that if you don't stimulate the economy enough, you end up underemploying vast majorities of people, and you have too high unemployment, too weak demand, and sort of a deficient demand for a very long time. And once you get into this trap, it's very, very hard for monetary policy to do much to stimulate us past that. So we entered this really obvious big recession, and it was so big that the fiscal authority got it and was like, let's not do that again. And a lot of what we're hearing right now is that, well, the fiscal, they too much stimulus to keep us from hitting a low equilibrium. And that's actually what we have inflation right now. And sort of corollary to this, if you go back to, this is, I think, probably from a 2005 paper by a very obscure economist. His name is John Williams, and he is the chair of the New York Fed. So I think they probably listened to him. This is showing up great, by the way. But the essential argument here is you have this virtually impossible to see because it's printed 20 years ago. And it's arguing that your correct monetary policy response is actually you keep rates lower for longer, wait until inflation has actually taken hold to start lifting rates, and you eventually arrive at a similar long-run equilibrium. But because you've the uncertainty of not knowing what it is, and if you're really worried about hitting the zero lower bound, inflation happened first. And so just like we can miss and end up a low equilibrium like we did in the last recession, what we not 100% of the inflation we're experiencing right now, but some of the elevated inflation that we are experiencing in this recovery is in fact exactly how policy rules say we should be doing this. And I think this is we have not talked about. It's not a trade-off that Fed people like to talk about. But, you know, if we are in equilibrium with, you know, what seems like a very, very steady trend of neutral rates, we've got this very fantastic low inflation target. Well, unfortunately, one of the consequences of this is when you get recovery policy right, you get spurts of inflation part of the recovery. That's literally the game plan. And this is not something that you are going to read anywhere in the media debate this year. It's basically just been, let's all light our hair on fire, gas prices are high, et cetera. And I get that gas prices are much more easy to explain than what I took 5 minutes to get through about neutral interest rates. The really interesting thing to me about this, though, is that this has been like a huge macro point that like it's a big enough deal that people have been able to publish descriptive papers in fancy macroeconomics journals for like 20 years. And yet we don't have a whole lot of explanations about why this is the case. So we know that interest rates have fallen globally. There's kind of the US context is sort of where this comes out first. That sounded lovely. Don't be. I've just decided to go full MC on here. So this was first observed in the US. You can see this in basically all global economies, all advanced economies. I think there's like a 2019 that's like Summers and Rachel or something, but it's, you know, if you look at the whole OECD, this is not like a US only thing. This has happened. And so the basic idea here is we have more savings than investment demand, and that's got to be at the heart of some of this. And if you work through this a little bit more, you get to something along the lines of there can be explanations for this that are savings based, and the sort of dominant one we hear is demographics, like we've got an aging planet and all this. The one you heard the most complex was this global savings led argument, which there's some interesting stuff that says that the US should be impacted here because excess uncertainty about neutral interest rates. People are much more interested in borrowing really safe assets, which look a lot like US Treasuries. It's a little bit harder for our central bank than other central banks, but it's still kind of the same global story here of, you know, we have a lot of demand for safe assets, and that ends up pushing down interest rates. And we understand what the monetary policy rules say about this. Again, filtering this through into the policies come with higher inflation, that has not happened yet. So we have the demographic story, we have the global story, and then I think the two we're here that are less talked about are that, you know, we're not actually solid literature that says like, yes, this is an inequality story. It turns out rich people save a lot of money, and like there are a lot of very rich people now, and that has an effect. And also there's like a non-trivial competition story that is relatively easy to spell out. I'm hoping it's so easy that I won't flub it, but we will know shortly. Here we go. I'm taking this particular construction from a paper from crowd favorite Greg Mankiw. Particularly, I've known Mark for like 10 years here, and it's great to be talking about how markups are affecting inflation in a way that mirrors what Mark was saying. Big words of Greg Mankiw. I know it's going to warm his heart. But Mankiw just has this very, very, I mean, it's perfect, stylized model. It's just like, yes, here is a solo model with markups. So your markups show up literally just in this one term. They combine, expect, and as you might guess, because it's in the denominator, it lowers the neutral interest rate. And then he does some, you know, really hand-wavy calibration. And his is that I think it's a 1% increase in markups should lead to about a basis point reduction in neutral interest rates. So he's very convinced that this is just a product competition story. We also think there's some monopsony story to this as well, but it's another piece of we have an inflation or we have a story that is about a change in market structure that is filtering through to higher prices. It's a little bit different than the story that we're hearing in other channels that are equally valid, in the sense that this is not just you have pricing power, therefore you can do higher markups, and that leads to inflation. This is a secondary channel. This is saying that these higher markups are also pushing down further on this neutral rate and causing the Fed to have to tolerate more inflation and recoveries. So it's a second effect of higher markups contributing to more inflation and recoveries, assuming we get them right. Now I'm going to pass to my more qualified.
And then so on the wage markdowns, I know that Josh Bivens already talked about monopsony a little bit today. But I want to sort of go through what I think monopsony would mean for monetary policy channels. So, overall, I think we know from monopsony that labor supply is suppressed because, or labor demand is suppressed rather, because it's an upward sloping labor supply and employment in this context. And what this means in practice is that wage adjustments aren't sluggish downward or sluggish upward, which is a little bit contrary to what we think about when we talk about wage rigidities. In fact, under monopsony, they would go down more easily than they would go up. But we also, under monopsony, that gives us a little bit of space too for wages to go up without playing into cost push inflation, because it cut into deadweight loss that we're capturing. And so it gives us a little bit of space to maybe explain some of the wage increases we've seen that wouldn't be going through the costs. What does this mean for the Phillips curve? I know we're going to hear about the Phillips curve tomorrow from Jay, and I'm really excited to see you because it's my favorite title for a paper in like the past few years. But I will try to add a little bit of insight of what I think this might mean for the Phillips curve based on the previous research, although it's a little bit ambiguous. Is that because there are entities that are less responsive to interest rates, but labor supply will be responsive to interest rates, we could have an upward sloping Phillips curve, which would means that in fact it would be a downward sloping Phillips curve. If you increase interest rates, it would have a counterintuitive or sort of opposite effect that you might expect by impacting labor supply. But where the ambiguity comes in is sort of how much is monopsony controlling these dynamics? Do workers have enough bargaining power to offset that? That would be a factor in this, or do employers fully have wage power? And so it's ambiguous which direction it would happen, whether it be upward sloping or down sloping, but it's sort of a remaining question of the degree to which monopsony might be changing these dynamics. And a final note too is, as Josh noted too, that there might be sort of a reduction in frictions right now facing workers, and that aligns with the standard monopsony literature. Labor market frictions tend to go down in expansions anyway. So that also sort of is a complicating factor. We think about what are the labor supply effects of interest rate increases balanced against the fact that workers do have better outside options right now. So it's a little bit ambiguous what would happen with the Phillips curve. The fundamental point is that it's not working how we think it would work. So there's more research to be done.
And yeah, this is just what like the last, I think this is our last slide. So there are 3 papers from last year that are, I think we just said, I'm going to say it's Mion et al, but it's related to my inability to parse whether a B is actually 2 S's in a German. But we have 3 authors who do a lot of really good work on inequality and savings. So I believe this is from their paper called The Savings Flood of the Rich, or just Rich. And they do a very interesting decomposition where they actually break down why they think our star is falling, and the actual income distribution of this is really significant. There's another of these papers that actually looks a lot more like what we're talking about here in a central bank sense, that gets to how you need, or how government growth or government debt growth may need to keep growing to keep interest rates from falling in a model like this. This sort of distributional component really does seem to matter, and it certainly points to policy tools we might think of as inflationary, as being a way to restructure kind of the long run balance of savings and investments, such that you don't end up with spurts of inflation and recoveries as a common feature, or it gives a channel that would let you make that less intense. I think one of the, like, if there is a takeaway we're trying to get across, it is very much that, while we shouldn't necessarily expect 8% inflation every time, some of us were like deeply wrong in, I think it was October of last year when we saw like 2.5% core inflation and we're like, victory. And then things reversed dramatically at that point. I think it is totally reasonable to expect that proper conduct of monetary policy, when we have the underlying conditions on movie, it's going to call for more inflation in recovery. And I don't think we did a great job of sort of, well, not we, I don't think the Fed did a great job of communicating that was sort of the game plan all along. And I think that may have led to, you know, some excess concern over what initially looked like not a huge deal. But you start to look at things like this, and there are very obvious policies we could look to that do things to reduce inequality. And, you know, some of these are things who make reasons may be anti-inflationary as well. We have a few questions going forward, and we are pleased to be talking to folks later today and tomorrow about our equitable growth funding round for this year. So come find us if you have interesting proposals. We're going to be looking for you. These are questions we are kind of casually working through, but you probably have better questions because you have research agendas and we want to talk about them. But I do think we're very curious about whether we are going back to too low inflation, right? Like either our start moved a lot and we'll know eventually, or it didn't. I think that there's not a great deal of evidence that suggests that the big underlying parameters that determine this have changed. So, I mean, I'm not going to give you my exact numbers, but my prior is that we haven't actually radically shocked the world. I do think there's like some weird communication stuff going on right now. I think part of that is the incentive for the Fed to be really hawkish, even if, to be fair, I started this slide like 3 days ago when Jay Powell had not said like, maybe we'll chill a little, which now looks less good. So I guess I'm glad I did then. But yeah, I think that's going to be interesting to see. And then some very interesting literature that we didn't get into here is credibility signaling by central banks. This is like you can do approach if you are trying to signal that you are reestablishing credibility. And I think that's what we're a little worried about, is that you may be in a position where it's beneficial to be too hawkish about that. But these are all things we talk about offline. Okay. I thought you would actually promise.
Yeah, I was about to say, I still can't remember.
This brings us to these presentations. John Baker from John Baker, also
Is this like, and I guess let's use the other.
And then go into.
it's below. Like,
Yeah.
All right, wonderful. All right, so a new project that I am working on with Arjun Jayab, also a product of this department, who many folks here know. The paper itself, I hope, will be available to distribute in the next week or so. Our goal with this is to sort of finally rethink how we imagine the supply side of the economy. This is relevant, of course, for current inflation, because many people understand it as a mismatch between aggregate demand and aggregate supply, although, as various folks have mentioned, there are other ways to think about inflation. The supply side questions have also been foregrounded by the pandemic, and are very relevant to a lot of the questions around climate change going forward, but they're also quite relevant to the experience of the past 15 years, which I think the post Great Recession period has also taught us some lessons about the supply side of the economy that I think overlap with That's my. Like. You can stop. It's exactly so. Yes. For me. Yes. Well, I mean, but I'm gonna have to tell you. Okay, next slide. Right, so, whoops, back. Well, it's okay, go on to the next one, it's fine. Our fundamental proposal here is that we should think about the, can you get full screen maybe on that? I don't know, so we can see the whole slide. Yes, that's great. Okay, perfect. Okay, so our fundamental proposal here is that in many contexts, it will be more useful to think of the supply side of the economy, to operationalize the supply side of the economy in terms of constraints on adjustment speed of production rather than the absolute level of production. That in many cases, what supply constraints really represent is the limits on the capacity of markets to reallocate production rapidly rather than an absolute ceiling to what can be produced. Clearly, that's not the way we normally operationalize the supply side. We think of a level of potential output, which is a path of output over time that's independent of current demand determined output, that describes a sort of long-term trend, that the gap between the current demand determined output and this exogenous potential output is what drives policy targets, inflation, and unemployment. And the long-term trend is determined by the sort of real productive capacity of the economy, meaning the stocks of labor, capital, productive technology available. Next. Next. So the last 15 years, I think, have really highlighted a lot of problems with this conventional conception of potential output. First of all, we've seen clearly that fluctuations in output are persistent. And sort of the corollary of that, growth does not, over expansions, does not look like a convergence back to a trend. We've seen very clear signs that the labor supply is endogenous to the current state of the labor market. We've seen many signs that there's a great deal of disguised unemployment in Joan Robinson's sense, that people are not performing the most productive activity that they're capable of. We know that the production process is endogenous to the actual level of production. And we've observed, particularly in the pandemic period, that we see supply constraints in response to changes in the composition of demand as well as the level of demand. Next. So the first point, which came out very clearly in the post-Great Recession period, is there was no tendency for output in the US, and all my examples are US, but I think we could tell similar stories for other advanced countries. There was no tendency for output to return to its previous trend. And this is actually consistent with the historical evidence as well. So either that means you take a sort of real business cycle view that all of these fluctuations are actually variations in supply rather than demand, or there's some sort of coincidence where, the financial crisis happened right before demographic and technological factors were going to be pushing us onto a slower growth path in any case. Or alternatively, we can say output remains away from potential indefinitely, which sort of contradicts our basic notion of what potential should refer to. Or the fourth possibility, which I will return to, that potential output returns towards actual output over time. It's not exogenous to actual output. Next. So this is the graph illustrating that point. We've all seen this graph before. If you measured the trend of previous output, which also looks like pre-2007 forecasts of future output, there is no convergence even after the recovery begins. Next. So the second challenge, which is sort of the corollary of this, is that growth over expansions, and this is true in earlier expansions as well, is steady over the expansion, whether you measure it in terms of output or employment. If we had convergence to a trend, you would have rapid growth immediately following, fall in output in a recession and then slowing growth, but we don't see that. We see steady growth throughout the expansion. Next slide. I stole this graph from Antonio Fatas, a paper called The Elusive State of Full Employment. The key panel for us is the right-hand panel, which shows very clearly in recent recessions, and it's true of expansions, it's true of the last one too, you can't see it at this scale. The growth in the employment rate, the age-adjusted employment population ratio, is essentially constant over the course of the expansion. This is, again, not a return to full employment where that rate should stabilize after the recovery. It is a steady growth in the fraction of the population that is employed over the entire recovery, which suggests either there isn't any relevant full employment rate or it is not reached in the course of recent expansions. Next. So then related to this, we have a lot of evidence that changes in labor force participation are not exogenous. They are tightly determined by the level of employment at the moment. Changes in participation rates over time are sometimes attributed to demographic factors, but if you dig into it a little bit, demographics do not really explain changes in labor force participation rates well at all. We also have large differences in employment rates by race, typo there, sex, education, which first of all are not plausibly related to ability or willingness to work, and secondly have a strong cyclical component. And then we also have a lot of evidence at the micro level that the experience of unemployment in a recession or entering the job market during a recession has long-term effects on people's employment prospects. Next, yeah, that's just showing CBO. Okay, so this is just the demographic point. If you look back, labor force employment rates, labor force participation, they're basically the same in this context because the unemployment rate is not too different from what it was then, peaked in 2000. The change since then is the decline since then superficially looks like it might be explained largely by the fact that the population has aged since then. But if you break out the within age group shifts in employment rates and then the effects of population shares, you see that the within group shifts in green are as large as the share effect. So this is not just a demographic story. It's shifting employment rates within age groups. Next. And in fact, if you break out the under 55 population where aging is not plausibly the explanation of labor force participation rate, the decline in employment rates is just as big as it is for the whole population. So again, this suggests that we are not simply looking at an exogenous demographically determined supply of labor. Next. Similarly, if you look at the gap between Black and white employment rates, it's always negative. Lower employment rates among Black Americans than white Americans, but the size of that gap strongly depends on the business cycle. At the bottom of a recession, 1982, 83, or 2009, 10, 11, the gap is very large. During periods following periods of strong growth, right before the pandemic or 99, 2000, that gap is much smaller. Again, that suggests that these differences in employment rates do not reflect differences in employment in labor supply, which really should be almost anybody who thinks about it should agree. This is not about differences in willingness or ability to work. It's about which groups of workers are favored by employers and which aren't. Next. Same story with education, not quite as clear, but same basic story. Next. And this is just, if we imagine, the question is, if you imagine that everybody basically was employed at the same rate as college-educated white men of the same age, how much more employment would we have in the country? And the answer is a lot, suggesting a very large latent labor force that is potentially available that sort of contradicts the claim that labor supply is an absolute cap on the number of people who are willing or able to work. Next. Okay, next challenge. Among those people who work, the conventional view is that their productivity and therefore presumably their pay is determined by their capacity to do productive labor. People are employed in the highest productivity, highest pay occupation that they can reasonably do. There's a famous line in the general theory where Keynes says the fact that 1 million people are unemployed doesn't mean that there's anything wrong with what's happening with what the other 9 million are doing. But in fact, there's this concept going back to Joan Robinson of disguised unemployment, that in conditions of weak labor markets, a large fraction of the population is doing low productivity activity. He mentions traditional agriculture. We can talk about family businesses, but also a lot of low wage service work, which strong labor markets can pull them out of into higher productivity and higher paying work. And one piece of evidence for that is the strongly pro-cyclical character of the premium for job switching. Next. So here you see the wages for job switchers versus job stayers, generally higher for job switchers, but strongly sensitive to business cycle. Tight labor markets, big premium. In deep recessions, no premium. And again, there are many ways we could interpret this, but one plausible interpretation is that many people are doing lower wage work that they're sort of stuck in through the various frictions in the labor market, and a tight labor market is required to pull them to higher wage positions. Okay, next. Next point, broader point, is that, but very important, is that production in a modern economy does not just take the form of capital and labor being combined to produce output. It takes place through concrete specialized capital goods and concrete specialized long-lived enterprises that produce particular things. There's pervasive learning by doing and increasing returns over time. And what that means is that the productive capacity of the economy is transformed through the process of production. We cannot treat the production technology as existing prior to what is actually produced. And a very clear-cut example of this we've seen recently is the steep fall in renewable energy that has followed policies to boost the share of those forms of energy. Next. All right, last challenge. We typically think of potential output as a level of output aggregate, but we see the same phenomena, the same signs of supply constraints, inflation, and so on, in response to rapid changes in the composition of output. We see this very clearly in the pandemic, where we see a shift from in-person services to goods, interruption in the supply of key inputs, and these, lead to a rise in the overall price level, suggesting a micro rather than a macro story of inflation. Next. So, for instance, if we go back to 2021, that says 2001 should be 2021. The initial rise in inflation in mid-2021 was essentially entirely vehicles. New and used vehicles, about 7% of the CPI basket, accounted for the substantial majority of the acceleration of inflation in the middle part of 2001. Then obviously replaced more recently by energy prices and now by housing. OER, whatever we think that measures. So the point here is you had a big spike, for reasons we understand, in the price of autos that was not offset by a fall in prices elsewhere. A shift in the composition of demand led to a rise in the overall price level. Next. Same thing with food. Here you see during the pandemic, big spike in purchases of food for home, yellow, big fall in purchases of food at restaurants, blue, but next. Prices of food at home spike as demand for food at home spikes, but prices for restaurant food do not fall as demand for restaurant food falls. So this asymmetric response, which suggests again that inflation and supply constraints can be associated with changes in the mix of output. Next. So should we throw out the supply side? No, we should not throw out the supply side. Constraints on the ability of the economy to produce stuff are real. Increasing the flow of money does not automatically smoothly increase the supply of output. We have lots of independent measures of supply constraints that we believe are real and meaningful. Okay, next. So our view then is that we would avoid a lot of these problems if we thought of supply not in terms of the maximum amount that the economy can produce, but the fastest speed at which production can be changed. And this reflects things that we really know are true about the world, but often abstract from in economic models. First, that employment and other economic relationships are socially embedded. People change when people's decisions about whether to work and what work to do are tightly connected with many other life choices that are hard to adjust. Second, production technology embodied in long-lived specialized capital goods and organizations. We have businesses in the economy that do particular things, something again that our models often abstract from. Third, coordination problems. Markets work well when you are talking about small marginal changes where people can essentially treat everybody else's actions as given and treat current prices as a guide to longer run production possibilities. When many actors have to change their choices at once, coordination problems arise that make markets poor at managing rapid, large-scale changes in activity. And finally, of course, we have pervasive, limited information and frictions in real markets. If you are a business contemplating some other choice about what to produce or how to manage your business, you don't have the entire universe of things you might conceivably do in front of you. Your choices are going to be the things that are relatively similar to what you're doing, the same thing for a worker. Large choices involve gathering information and take more time to carry out. We don't have the entire universe of production available for us to pick from at any given moment. Next. So bringing this perspective back to some of the puzzles that we talked about earlier. We've often thought about the persistence of the fall in demand after the Great Recession in terms of hysteresis. This word became very common for a while in macroeconomic conversations. A very common way to model that is to say that potential output, Y star, at a given period is based on some exogenous growth rate from previous level of potential output plus, to some extent, the previous output gap. So we've got some parameter alpha that shows how the output gap is carried over into present alpha. The output gap is carried over into potential output. The thing I want to just point to about this is if you believe that there is any significant degree of hysteresis in the economy, then a permanent shift in aggregate demand will lead to a transitory output gap. That a permanent fall in demand, for instance, will lead to only temporary deflation or disinflation, only temporary unemployment as potential output converges to the new level. So in a framework with hysteresis, you are, in fact, without sort of explicitly realizing it, modeling supply constraints as costs not of the producing too much, but of moving too quickly towards a higher level of output. Next. Similarly, in terms of labor supply, I think this is very important that we don't imagine that there is a fixed number of people available to work so that we reach a state of full employment where we have employed everybody. There is a smooth gradient of people who are closer and further from employment. Some people are very easy to hire. They don't have to change their expectations or behavior to accept the sort of job that is available to them. Employers don't have to do anything different to hire them. As you move down this gradient, you get people who are available for work, but who there's some transition cost in getting there. People have to go from not expecting to get a job to getting a job and make the various changes that go with that. And employers have to be prepared to hire people they currently don't consider desirable employees, or to make efforts at recruitment, training, and so on that they're not currently making. And of course, we can go down here, we get to immigration, which is a very important adjustment cost. Costly to immigrate. Once you do, you are there and available for work. And over the long run, we could even add population growth here. So we cannot think of a sharp line between people in the labor force and out of the labor force. Rather, in a situation where we're facing labor supply constraints, it means that people, workers and employers are having to change what they do in order to hire, and that has cost. Next. So again, when we're talking about the composition of output, because firms are specialized, there is a cost to producing something different, and you cannot easily reallocate resources from one part of the economy to another. That takes time. So the model we should have in mind is a typical firm has constant marginal costs over its normal range of production, but costs rising very steeply above that because it uses specialized capital goods and an organization that can't be scaled up instantly. In this model, when a firm produces less, when a firm faces less demand, the quantity it produces falls. There's no reason for the price to fall in this scenario because the costs don't fall, because inputs are relatively unspecialized. When demand rises above a threshold, it's price that increases, because the fact that firms are specialized means that you cannot increase demand of a particular commodity very quickly, even if the inputs are in abundant supply. Next. So that's that. Next. So just incidentally, some people say the reason we have this asymmetrical effect is because prices are inflexible downward. I think that's backward. The problem is that the production process is inflexible. The flexibility of prices is a problem in this scenario because it allows very large spikes in the prices of the goods facing increased demand faster than the adjustment process that boosts capacity in those sectors can happen. Next. So this is just saying, again, if we take this adjustment cost view, then we will expect to see that permanent shifts in demand lead to transitory output gap. We will expect to see that a macroeconomic policy that aims at restoring full employment or target inflation will not have to get back to the earlier trend, but simply return to the earlier growth rate. we will see that labor force and productivity growth are functions of current output. Because again, the constraints there are not the level of labor that we have available, but the cost of bringing labor into the labor force. And we will see inflation when composition of output changes, and we will see that binding supply constraints are associated with changes in relative prices. Next. And finally, this leads us, I think, to a vision of the economy that will be more congenial to those of us in the sort of Keynesian or heterodox tradition. First of all, a conventional vision of sort of supply and some sort of supply is fine as a description of the local situation, given the level of output and the composition of output we currently have, the organization of production we currently have. It is perfectly reasonable to say that producing more will be costly. Producing something different will be costly, but we cannot treat those local facts as indicative of the overall or long run production possibilities facing us. Short run price moves are not always, or often not, informative about our longer run production possibilities. Very important in the current context, and I'm just going to finish this slide because this stuff is important. Very important in the current context when you have a rapid change in either level of demand rise and fall or the composition of demand. We should expect to see large price increases that are not telling us about the long run costs of production. And if we interpret that way, we will make a lot of mistakes. They're telling us about the cost of the adjustment to the new situation. We should not try to separate out the real resources of the economy, the labor and capital and technology, away from our current production. Those things are inseparable. We should keep in mind economic growth is path dependent and open-ended. There is no long run growth path that you can model, and I think we should stop trying. And finally, that the fundamental supply problem we face, the supply problem that we need to focus on solving, is the limits of market coordination. The reason we face supply constraints, price spikes, shortages, and the rest of it is because markets cannot reallocate resources as fast as we sometimes need to do. That means that we see very large changes in prices and incomes before output can adjust. And those changes in relative prices and incomes are in fact one of the central costs of inflation. So we need to limit those disruptive price changes in the short run so that we can get the adjustment to capacity. And finally, if we need, for whatever reason, to make faster changes to the kind of production we are carrying out, to the character of it or the level of it, we are going to need greater use of non-market forms of coordination, planning of various kinds. And there's actually one more bullet that didn't show up there, which is that income distribution is a central part of managing supply constraints.
Still looks horrible.
Thank you so much. We now have Eileen Appelbaum as a discussant who's already here. Wonderful. Take it away, Eileen.
Okay, well, first I want to thank Bob and Jerry for having the foresight to organize this really interesting conference with lots of new ideas, I think.
Unfortunately, we cannot hear you. Can you hear us?
Wait. All right. Okay, give me a second.
Okay, it seems to be an issue physically in our room, which we are trying to figure out. This is the session on supply chain issues and supply shocks with some real-time illustrations.
What is work? I can hear Eileen quite well.
Now we can also hear whoever was speaking there.
Yeah, can you hear me at all?
Now we can hear you, yes. Marvelous.
I cannot ever figure out how to use these headphones appropriately. So I wanted to just thank Bob and Jerry first for organizing this conference, which I think has brought up a lot of new ideas and different ways of looking at things that I think are going to be really important. And I think that's true, especially of the papers in this panel, of course, in the other panels as well. But there are a lot of really interesting insights that have not really been that much discussed. So I want to make a few general comments before I talk about the papers. To get back to Bob Poland's original question about what do we tell the finance minister in Chile to do about inflation? I don't think it would be the same as our situation here, but it is a really good question. And I think that the answer lies largely in the original insight that Bob Kuttner put forward, that other people here have also had, but that he emphasized that this inflation is not due to macroeconomic forces, but it is micro. There's a lot of microeconomic basis to the inflation, and so different things are happening in different markets. The kinds of policy proposals that can address these micro forms of inflation, I agree, take time, but also some of what we're seeing is resolving even in the absence of policy. I would put here, for example, the points that were made about the fact that rents, as they're measured in the CPI and the PCE, are beginning to moderate just because we've reached the limit of what the transformation in terms of people working at home, wanting more space, and the affordability of it. That's come to that's really flattening. If you look at the shipping costs that Bob Kuttner talked about, they're now back at pre-pandemic levels. We can talk about other prices that are leveling off, some of them even falling, as these problems of adjustment get ironed out. And so it's true that transitory inflation was less transitory than we expected. And this is partly due to the points that Josh Mason was making about the difficulties of coordinating these transitions from the increase in demand for goods during the pandemic and the shift back to services after the pandemic. These changes in the composition of output are really difficult to accomplish just through market forces. More difficult, I think, than we imagined, and partly because we do have private equity, as Jamie pointed out, buying up fossil fuel and restricting the output of oil. We also have, was not mentioned here, but the refineries that went offline during the pandemic, many of them owned by Wall Street firms, even private equity firms, have not brought capacity back to where it was pre-pandemic, and that makes it really hard to keep oil prices down. But a lot of these are resolving as just with the passage of time. I think that the short run answer to inflation in the US at this moment is patience. I think that Powell is under extreme pressure from the likes of Larry Summers and from financial markets to cause a recession. They want a recession. That will somehow justify, I don't know what, but that's their goal. Let's have a recession. Let's put an end to all of this high demand for workers and wage increases, especially at the bottom, and worker power and union organizing. Let's just have a good old-fashioned recession and get back to where we were, with employers being able to dictate everything and raise prices as they want. We need equal pressure from our side. We need to be making a strong case and give Powell strong reasons for why he can go more slowly. And the argument that recession is bad is falling on deaf ears. Everybody knows recession is bad. Even Larry Summers knows recession is bad, but that's not a reason not to have a recession from their point of view. I think the argument that the current inflation has microeconomic foundations and not macroeconomic roots is a much more powerful argument, and one that many more of us need to be making. And those of you who are making it need to be making it in a way that policymakers, the Fed, that this can be understood. So I think we have some really powerful arguments coming out of this conference. I think they need to be magnified. I think we all need to be writing about them. And those of you who really have an audience, like Dean Baker, who unfortunately couldn't be here today, but like Josh Bivens, like Josh Mason, I don't want to insult anybody, Jamie Galbraith, many of you have the ability to be heard in Congress, in the Fed, at the Treasury. You need to be making the argument that this inflation has micro foundations and has to be addressed on that basis. That just shutting down demand until it got bad enough that the inflation goes away is not an answer. And as some people have pointed out, the inflation is going to go away with or without, the extreme inflation is going to go away with or without monetary tightening. So I really think that's one important lesson out of here. So since I've used up some of my time with that, I'm going to just hit on what I think were a lot of the really original ideas and ideas that we're not talking enough about that the papers have raised. Marc Jarsulic did not really go through the careful analysis he had in his paper, sector by sector, of what the causes of inflation in that sector were. And the policies that he didn't really frame it as this recession, this inflation has microeconomic roots. But that is really, I think, a major point that emerges from this paper. He did talk about, and there was an increase in demand and employment that probably contributed something to inflation, but not so much because we had the increase in demand. It's that the increase in labor supply was limited by by a couple of things. One of them is the lower labor force participation rate, as he pointed out, and the other is the lack of immigration of working age people, individuals who could contribute to the economy. So I thought that those were really important insights. He argues inflation has many sources and the Fed has only one policy tool. So I think, again, that's an argument for talking about the micro foundations. The paper by Kate Bahn and Michael and Carmen emphasizes a completely different point that has not really been talked about much. And they are talking about the fact that for at least the last 2 decades, maybe longer, the neutral rate of inflation has been pretty low. And while they didn't give a figure, I think most people looking at this would probably say that the neutral rate of inflation has been somewhere around 2%, maybe a little higher, but not much higher, which means that in a period of low unemployment and the danger of deflation, the Fed has no tools. So really, what you want is a higher natural rate of inflation. And how do we get there? I mean, neutral rate of inflation. And how do we get there? One of the ways we get there is by having inflation as we are having right now. And so one of their questions is whether what we are observing currently is a deviation from that low neutral rate of inflation or a change in the trends of the neutral rate of inflation. And this, as they say themselves, it's a little early to come down, definitely, but they feel that their underlying analysis points to deviation from a continuing low neutral rate of inflation. And they talk about the savings glut. The foreigners seek a safe haven here in the US for their savings. The wealthy in this country do not save, although we do have the Ferguson paper with the wealth effect in this particular recovery from recession playing an important role. So we need a little more thinking about that. But their basic argument is that a private investment has not kept up with the savings coming into this country and coming from wealthy people not spending their incomes. And that is what is depressing the neutral rate of interest. And that's probably a true statement. I was surprised that they only say in passing that, well, the answer is more public investment. But at least I had an early version of the paper to read, at least in that version, they say, well, this is going to be a hard argument to make in the midst of, concerns about inflation and austerity. I think it's the most important argument to make. And I think that if anything, the Biden administration has heard them. It is really working double time to increase public investment. And we've seen it in a number of the acts, which I'm really surprised that they did not think to talk about what the possible implications of these policy changes are for the future of the neutral rate of interest. So we have the Inflation Reduction Act with its spending on climate change. We had the Bipartisan Investment in Infrastructure Act. We have the 2022 CHIPS and Science Act. And then we have heightened action to enforce antitrust from the FTC and the DOL. So there's certainly been progress during the Biden administration, for which he has not gotten any credit, towards raising the neutral rate of interest. So I think that there is a possibility, at least, that trend is changing and that this is not just a deviation. There were other points in the paper that the connections were not really clear to me. So a low natural rate of a neutral rate of interest. We have a low neutral rate of interest. It's a problem when unemployment is high, but I don't see how this is a problem at the moment. At the moment, we have tools if we want to use them, and Larry Summer certainly wants to use them for reducing inflation if that's what we want to do. And we have strong arguments for why we may not want to reduce inflation all the way down to 2%. Having to do with how it undermines the Fed's ability to deal with the opposite situation of high unemployment. We're not making that case very loudly or very prominently. So if that's what the case that we're trying to make, that we need inflation now in order to get off of that low interest rate, low inflation rate environment that is so difficult for the Fed, we need to be making that argument more clearly. And of course, I agree with everything that was said by Kate and others in her group on monopsony and monopoly. These are points that I've made myself and I think are really important. I don't understand, and I understand how they might be related, that these are changes in the structure of the economy, which need to be dealt with, and may be sources of inflation that you can't really eliminate just by raising the interest rate. I get all of that. It's really important in this paper. I don't understand the relationship between a low neutral rate of interest and monopsony and monopoly and its effects on the economy. That link was not clear to me. And then finally, moving on to Josh's paper, hooray, hooray for challenging the potential output as the supply side of the economy and just letting it go at that. I think the points that this paper makes about why that's not a good way to look at things, these points are really important. And I think it was very persuasive. So I think we all should be making more of some of the points that they make in this paper. One of which is that in the short run, it's much more easy for prices to adjust than for output to adjust. And so we see these spikes in inflation. They are not a guide to what is going to happen long run in the economy or where resources should be allocated. Those decisions are being made not in response to these short-term price increases, but elsewhere in the economy as they describe. And so the problem is not that you want more flexibility in prices. The problem is that you want to limit the flexibility of prices. You want to perhaps cap some prices. And what you really need to do is and limit the disruptive effects of these price changes. But what you really need to be thinking about is how are we going to reallocate resources more quickly and in a better way without the price signals doing it all for us, which in fact they are no longer capable of doing. So the fact that we are going to need more coordination that is outside of these market price forces is a really important point. It's not clear to me how we get there or what Josh and his colleagues would say would be the next steps or the right way to think about this kind of coordination. I assume that they're thinking a little bit, at least, about industrial policy, about a green transition, things like that, which I think are really important, are not due to these price signals, but really talk about how we need to reallocate capital and labor in this economy in order to have sensible growth and better income distribution and more powerful countervailing forces to the power of finance and the capital in the form of more power to workers in the economy. So I think that these papers all made extremely important points. I think we need to be thinking here about how we get them into the mainstream conversation and how we get them to Powell in a way that enables him to go more slowly on these price increases, or to halt them for a while till we see what will happen. We need a pause, and I think that the argument that the roots of this inflation are not macro but micro is the way to go. So I'll stop there and thank you all for these great papers.
Thank you very much indeed. So we now open up for the last round of questions from the audience, and we will proceed as before.
All people, or should I?
Please.
Here.
Thanks a lot for wonderful presentations. My first question is about Josh's paper. And, basically they speak about the fact that it is not that, the basically declines or increases in, current output may have a sort of long-term effects, which can make basically labor markets and some other decisions affect. So in a way that basically they claim that alpha is not zero, as in the case of mainstream economics, right? So I wonder if, Josh, you have ever thought of these non-linearities, for example, under which conditions that alpha basically should be important, or is there any case in which maybe this kind of fluctuations may not have distortive effects as you suggest? So I wonder if there's a sort of threshold effect After which, as in the case of COVID, basically I'm referring to COVID, right? The shock was so different. That's why could we generalize this kind of shocks to understand these overall macroeconomic issues as you are trying to do?
Hello. I would like to, make two questions. One is in one of the presentations, I believe in the one in the Washington Center for Equitable Growth, there is this question if we should be afraid that central banks would raise interest rates just for the sake of regaining credibility. So would they think that is a fundamental path to regain credibility? I think it is a real dangerous that even if they think we are not in a, let's say, overheated economy, they will choose to do it just to regain. And in fact, there's a paper by Ricardo Reis that in fact was advised by Mankiw and is now in LSE. And let's say its main argument is not at all related with an idea of an overheated economy. Its whole argument is the following, like central banks push too much, use too much the credibility that they had gained in the last 20 years. So now they lost it. And because they lost it, we are not anymore in this horizontal Phillips curve. So what we need is to increase severely interest rates, not for the sake of closing some kind of output gap, but for the sake of regaining credibility. And this is a dangerous argument because what they are selling is the idea of a costly process, because, you know, they really believe that they will be able to achieve this in this kind of forward-looking behavior of agents. If we believe that they will achieve their target, it will achieve without the need of creating this big pool of unemployment. And that is part of the argument. I think it's totally misleading, but it's part of the argument, and it is part of the public discussions right now. The second point, the second point, very quick. If I understood from the presentation by Josh, a great part of the presentation is just trying to make the point that potential output is endogenous, and so we should not go to recessionary policy because it would have like path-dependent effects. And the other idea is that much of these in sectors that are not related with these bottlenecks and these supply chain disruptions, these price changes that we are seeing is fundamentally a price noise from this reallocation of spending, right? I mean, even being inside that markup framework that you created, in fact, that you suggested, in fact, for instance, people like Marc Lavoie, they are trying to argue that, in fact, the main way in which you are seeing these, let's say, the contagions between, let's say, the sectors like oil and so on, and the other sectors is because in the other sectors are applying markups not only above unit labor costs, but also over what he calls unit material costs, that is very much related with the oil and so on and so on. So I'm wondering if it's a little bit more than just that kind of allocation and if markup may work. Thank you.
Okay, can I skip you? I'll try to be quick on Mike and Kate's paper, just quick, kind of a quick point. I totally agree that like there are mainstream models that say when you're near the zero lower bound at all, you should overshoot on inflation as you enter the recovery. And I think we've talked about this, but my gut is like everyone's going to say, but not like this. Like this is, and I'm wondering, maybe that's wrong, or is there any number to put on that? Like, what is the optimal amount of overshooting? Because I feel like before 2019, we were trying to convince the Fed that like overshooting by like 0.2% is fine and don't freak out. Maybe I was just wrong. Maybe like we should have been much more ambitious, but I'm just wondering if you have any numbers to put on what is the right overshoot and how much was a real overshoot this time. And then on Josh Mason's, just really quickly, I totally am convinced by like the speed limit effect. Like it's not just the levels of, and I just totally despair of measuring that with US data over the past 30 years, because we have not pushed the growth rate at all over that time. And so I'm wondering if you have any thoughts at all about how you might plausibly measure that.
So this is an outside the box question that grows out of this discussion. Let's imagine we're having a sequel to this conference in 10 years, and we're going to be discussing how to understand the inflation of 2032. A lot of the inflation in 2032 is going to be climate driven. Water is going to be more expensive. Food's going to be more expensive because water is more expensive. A lot of energy, renewable energy that relies on water is going to be more expensive. Keeping coastal cities from being inundated is going to be more expensive. That's not demand inflation. It's not quite simple. What is it? What kind of analytical tools are we going to need? And I especially pose this to the Washington Center for Equitable Growth people, because you fund some of this stuff. What kind of analytical tools are we going to need to understand the climate-driven inflation that is going to be coming at us big time that doesn't fit any of the traditional categories?
Okay, we're going to have one more short question here, then we're going to have a question from Jamie Galbraith, and then we'll turn it all back to you.
Okay, thank you. I've already somewhat unintentionally made my remark about the source of oil, the power of oil, and essentially as a power play due to the financialization of that sector. I want to suggest that the rise of interest rates is exactly the same thing, a power play, that it is an illusion to think that the Federal Reserve or any central bank is motivated primarily by trying to drive the macroeconomy. It's motivated by the interests of the financial sector, which in this case are their own profits and their position in the world economy at this moment, probably driven by severe financial stresses in other parts of the world, notably in Europe. And I think you see a lot of cover when you're fighting inflation and so forth. But I think it's reasonable to consider the possibility that it's not really going on. And the history of central banks, I think, is full of evidence that their primary concern is with the interests of the financial sector at a particular moment. So I'll leave that on the table. And as for Bob's question that was just offered, I have a two-word answer. It's biophysical economics. It's an entirely different way of looking at these issues. It does give you some insight into what we're going to face with climate change and the rising cost of energy. And the book will be out in a year.
Hello. Yes. I'm once again Gregor Semeniuk at UMass in Perry. I mean, at Perry in UMass. And just on Mark's point about OPEC as a cartel, the big oil companies, maybe not the OPEC national oil companies, but the international ones will actually tell you that they're investing in line with an energy transition, and they're worried about having stranded assets in 20 years. So they're just doing what they're being told they should do. And the demand side does not adjust. And that leads me to Josh's point about these the speed of adjustment, which I think is a very interesting way to think about this. And I think maybe you want to comment a little bit further about how would this inform an analysis of a fast energy transition, and maybe add to Bob Kuttner's climate, physical change driven inflation, also a transition driven inflation, also longer term.
Okay, thank you very much for a great set of questions. We'll now give the floor back to the speakers. I would say we start in the order in which we presented the papers. So Mark, why don't you start?
Excellent. Well, I want first to reply to Jamie's written comment about domestic oil production as being a big part of the run up in prices. He may be entirely right that that also is the action of a cartel, that there's kind of common investment or coordination between the financial firms that have moved into fracking and now control the funding. The problem that I have is that I don't have data that can really inform that. A bit of analysis for me. That is, one of the distinguishing things about private equity is that it's private. And so it's very difficult to, from the outside, to understand those connections. And Jamie may have much better information. I mean, it is clear that the financial decision-making on the part of the people who own and fund domestic oil production has really changed behavior and has changed supply, right? But it's not entirely clear to me whether there's concentration and coordination there.
Okay, I have a few of these. I guess I ran out of room on my paper, so I'm going to start with Josh, and then I'll do the one I wrote second. So is there an optimal amount of overshooting, like an overshooting star? I do not have an overshooting star. I think there is a difference between whether, like, what the optimal level of overshooting in a sort of stable state and in a recovery looks like. And, I'm not going to sit here and tell you that like 8% is the optimal amount of overshooting for inflation because, to like wildly misquote a phrase, I think that inflation is everywhere a political phenomenon, and you pick your level and you sort of shoot for that. But I do think that the idea that you were going to overshoot by like a couple tenths and then get back to where you wanted to do is probably not how we should be thinking about this. I think like for maximal Fed credibility, what you wanted to do was make sure you didn't get caught in a liquidity trap again, because we definitely had credibility issues with too low inflation for too long. Somehow that was not big news in the way that it is from this side. But the appeal from, having inflation escape in some sense is you get to show yourself as, now we've hiked rates a ton, we've hiked them really fast, which is exactly what these models say you should do. And then you actually have the leverage to push down from above as opposed to trying to push on a string from below. So, I mean, I'm a little less worried about hitting the absolute target. I'm like less than thrilled with how the last year's gone for a variety of reasons. I'm probably a lot less like down about how this went than I would have been a month ago if things had gone as poorly as we thought they were going to in November. But yeah, I don't have a great answer for this, but I do actually think that like the scope of how much you were going to end up overshooting in a zero lower bound recovery was actually like pretty large. And I think maybe what I'm getting at is, I think a lot of the point you're making is really good here in the sense that like this was just not communicated. The other half of this literature is like, oh, it's really important to get your forward guidance right. And no one was saying like, okay, so here's the plan. Like we're going to come out of this recession. There's going to be a big spurt of inflation. Then we're going to beat it down. Like at no point was that said. And I think that was like a big mistake. This segues beautifully into the credibility question. So I am really worried about the sort of the credibility signaling stuff. I think the worst version of this we've seen was, I'm going to get the month wrong, but I think it was like the July press conference. Someone was asking Jay Powell about how they were doing on their inflation target. And, he went from talking about the core PCE rate to just saying like, yeah, we're trying to get headline CPI down. And, at that point it was like gas prices were like half of inflation. And, so much for like, where did that come from? That was like a really, if they really did want to beat down like overall, that was like a very weird policy shift to make without any advanced communication, just kind of off the cuff. So I do think there is a bit of a concern with this, but I think that, in the longer term, it really is the bigger risk to credibility is undershooting from below, just because we know that can be persistent. And some of the literature I'm talking about is kind of about how you optimally switch regimes between, like, if you do want to reoptimize to a higher inflation target, is it better to do it before you get inflation all the way back down? That stuff's all like really gross and technical, and I'm mildly happy to talk about it offline. Oh, I really did like the climate inflation question too. I think that's, that's like a really hard one that we're definitely thinking about. Did I mention we're talking to people about funding things? I think so far, a lot of that looks like it fits in something like supply shock land. But I think the biggest problem that we have with that is that we're very focused on speaking to policymakers, and policymakers that we deal with, at least, are like, there is the federal budget, which is 99% of economics, and then there's 1% that's like everything else. And if you go and walk through, like, well, what would be the effects of like submerging Miami? And it's like, well, on the federal budget, there's very little, but like on the Miami property tax base is very large, but that's not in CBO land at all. So I think like ways to better quantify effects on not the federal government, but in ways that can plug neatly into CBO land, like that's like what I've been banging my head against the wall with for a while now. I think that was it. Okay, I'm going to pass to you, and if someone hates you later.
I think he had.
We pre-negotiated, I swear.
Yeah.
All right, so Hassan asks, essentially, is the COVID shock generalizable? Is it informative about supply constraints in general? And I think it's a really good question. I think the situation we're all sort of in here is we look at the inflation the world is currently experiencing, and it does not look like a textbook, aggregate demand exceeding aggregate supply shock. So do we say, well, this current inflation is different from other inflations, or do we say, maybe we've been misinterpreting those other inflations as well? And I think both perspectives are valid, but we're definitely trying to take the second one, that the COVID experience is informative about supply constraints in general, as extreme events often are. I think that I talked a lot about the post-Great Recession experience. I think we saw sort of on the other side, very clear evidence that most of the ways in which we measure potential output are in fact responsive to demand, and not just to the fundamentals. And I think when it comes to labor employment and labor force participation, we have a lot of good evidence that this people's movement in and out of the labor market is very much a function of labor market conditions and is not something we can treat as given. The sort of other side of it, the productivity side, organization of production, is harder to measure in that way, but I think we have qualitative evidence that these are general phenomena. In terms of the I don't remember if that was also Hassan or if there's if it was somebody else, but the question of transmission via input prices, that's Isabella's thing. So we'll hear from her tomorrow. The only point I want to emphasize here is the sort of story I'm telling is that you have a kind of normal range of output in which we can talk about prices as markups over costs, because costs are relatively constant. But once you move output, once you get above that range, you can't really talk about markup pricing anymore. If anything, you really should say costs now are a function of price, because the price goes to wherever that relatively fixed output is gonna clear the market. So markup pricing is relevant over a normal range of output or demand. Josh's question about measurement, I mean, one of the reasons that I find this conception attractive is that it seems like it's tractable to measurement using the same kind of data that we would use to try to estimate potential output, as opposed to sort of woollier concepts of supply that might be more attractive in other ways, but would be very hard to operationalize. But it's, I haven't actually tried to take that step. Arjun and I haven't. And then the last one, the adjustment costs and the energy, in some ways, that's really where the thinking here started, is precisely with that question. I think one way to come at that, one dimension of that, an important aspect of the sort of adjustment cost view is pervasive increasing returns. So let's take the case, because increasing returns mean that your current cost is not a guide to your long-term, possibilities, and that you may have to go through a period of producing at high cost before you can produce at low cost. So that is a form of adjustment. And I think there's a very specific example, which is very relevant here, which is the fact that we have an energy transition where not so many years ago, sustainable forms of energy were much more expensive than conventional fossil fuels. And so under those circumstances, if you tried to straightforwardly use the price mechanism to carry out the transition, you would need a very high carbon tax. A very high carbon tax is going to be very disruptive to all the other activities in the economy that depend on energy, is going to involve very large redistribution of incomes, and it's going to be politically impossible to carry out, as we saw in France and other places. So trying to just adjust the prices under those circumstances is, but on the other hand, because you have increasing returns, a set of targeted subsidies in whatever form to the new form of energy will move it, will move, as they move output up, will move costs down to the point where it is cost competitive, as we're seeing with, you know, solar and wind power today, and you don't need those levels of subsidies anymore. So that is really, in my framework, I would think of that as a form of adjustment cost. Those subsidies are part of the process of adjusting from one energy base to the other. And I think I'm absolutely convinced the climate, you know, transition is going to involve a lot of cases like that. And of course, a lot of cases where you really do have the coordination problems. If you want to transition from a more dispersed to a more, you know, urban pattern of settlement, that's not a good problem that markets solve, because there's so much infrastructure that has to happen, and there's so many people who have to make that decision sort of together. So I think that to do that quickly really does call for a lot more sort of centralized planning. I think, again, for me, that's almost like the sort of core case that this framework is sort of meant to apply to.
Okay, terrific. Thank you so much. We have like 5 minutes left but if there's one more question, but otherwise we might also discuss how to get to dinner. Okay. So is there any final question in the room? Then I hand over to.
Okay, well, first of all, thanks to Isabella for running the panel. Thanks to all of you. I think it was a very productive day. I know I learned a lot, and I hope many of the rest of you did. Thanks to the speakers today. Tomorrow, we're going to go again, same place, but not same time. We're going to meet a little bit earlier. Tomorrow, breakfast is from 8 to 9 in downstairs in the atrium, and our first session here will be 9 o'clock, and we'll find out about who killed the Phillips curve, a murder mystery, as well as many other things, including a lot about the supply side and inflation and care services in the US. So that'll be our first panel. Thanks again to Nicole and Kim and Aaron for running the show here. Good job. Thanks to Eileen for rallying us to get going, as always. So thank you very much. And in the interest of helping with the coordination problems, if any of you panelists need a ride after this, please come up here and I will coordinate to get you one. So thank you very much to everybody. See you tomorrow.
Thank you.
Okay, thank you.
Thank you.
Yeah, I was thinking.